Welcome to this video module on the mergers and acquisitions process. First item to discuss is why companies go through the M&A process. Strategic buyers might be looking to augment their existing business. For example, IBM might want to add software to its suite of products that it offers to customers. A buyer might want to expand the geographic reach of its business. For example, a US group buying website might buy the top UK group buying website to get into that market. Buyers might want to get into a new sales channel. For example, a biotech company that's been focused on R&D might buy an existing drug business to gain access to a network of sales reps. A buyer might know that it can achieve significant operating synergies. For example, two companies in a closely related industry might know that they can close an entire corporate office, save some overhead, and boost their earnings. Some companies buy businesses to stop their competitors from doing so. And investment bankers might just have brought a potential deal to management's attention. Financial buyers, likewise, purchase price and growth rate are a formula for excellent investment returns. Sometimes they're not as interested in the business as long as it's a good cash flow generator with good profitability. Potential buyer might have experience turning around struggling businesses, either in a similar industry or just experience with struggling turnarounds in general. The buyer might have access to a top-notch management team that it wants to put in place at an operating company. Furthermore, financial buyers might focus on businesses that can be too small to be considered by strategic acquirers. The process begins, basically it's a two-round process. Round one takes place after a bank is hired, which would have gone through a pitch book process and winning the engagement. But basically the bankers would work with management to compile a list of potential buyers, both strategic and financial. The bankers would then contact those potential buyers and gauge their interest in a potential transaction. Interested buyers might be sent what's called a teaser or an executive summary, just a short document describing the acquisition opportunity. It might not even say the name of the company if that's sensitive, but just saying, hey, here's a business in this industry, here's some numbers on it, it's for sale, here's some factors that you may want to consider when you're thinking about an acquisition. In the meantime, the bankers, especially the junior bankers, would start working on creating the confidential information memorandum or offering memorandum, sometimes called a CIM or OM. This is a large document, basically kind of the size of a business plan. 50 pages or more, contains detailed financial information about the target, its products, marketing, management, industry, it's any legal issues to consider, discussions of its technological systems, and an overview of financials, both historical and projected. After signing confidentiality agreements or non-disclosure agreements, potential buyers can be sent a copy of the offering memo. And the bankers would accompany that with a letter whereby they set a deadline for receipt of indications of interest or non-binding letters of intent that basically have to include an offer price, sometimes include an offer range. And in conjunction with management, the bankers will select a few bidders to advance to round two. During round two, bankers work with management to prepare a presentation called a management presentation that includes lots of coaching of the executives who are going to present it. The presentation covers many of the items in the offering memo, but it's also a chance for buyers to see the management team in action. The management team actually presents this to potential buyers. Bidders are invited to arrange site visits. That can include going to warehouses, offices, stores, other sites related to the business. The management presentation could even take place during one of these at the company's main office. The bankers have to gauge from management how to treat visitors to places. Sometimes the fact that a company is for sale is quite sensitive information. The visits may need to be masked under certain excuses so as not to arouse any rumors or suspicion from employees or others. Next thing to do would be arrange data room visits, either real world or virtual. But basically, a junior banker spends a lot of time, works with lawyers, works with the target company management to assemble materials for what's called a data room. It's a room, like I said, either real world or online, that includes legal documents, leases, contracts, detailed sales data, maybe sales by product or sales by customer, sales by region, just much more detail than was made available in the offering memo. It could list suppliers. A lot of times this is very sensitive information. It is often instructed that bidders not take the information out of the room. Sometimes a junior investment banker or a junior lawyer will stay in the room to make sure that, that none of the potential bidders take any sensitive information from the data room. Bankers and lawyers would next distribute a draft purchase agreement to the potential bidders along with bidding instructions, basically saying, hey, we'd like to be acquired. Here's the legal form that we'd like to see used for the acquisition, and here's the due date, and you better come to us with either with financing in place or our bankers have explored some financing. But next step in the process, just about the final step, would be for the bankers to receive these final bids, usually in the form of a marked up purchase agreement, and work with the client, which could be management, could be board of directors, work with the lawyers to negotiate a definitive deal. Sometimes that includes issuing a fairness opinion, basically a bank doing a valuation and putting its name on the line, giving it an official opinion that a deal is fair to the shareholders. And then closing follows after that. That's it for this module. Thank you.